Welcome, everybody. Just glad to see everybody back on the channel here. So for those that are brand new to Savvy Investor on our YouTube channel, welcome to all. For those that don't necessarily know who I am, my name is Mike Ponte. I'm the founder of Savvy Investor and longtime Canadian real estate investor as well. So I announced this today's training session on multifamily commercial financing, and honestly, my inbox kind of exploded. This seems to be an extremely hot topic for a lot of people, and very, very excited about this. So I was just getting peppered with a bunch of questions, people that are getting into this real estate space, and really excited about getting going and getting started. So for those who's here interested in getting into the multifamily world or multifamily investing, or who's in it, and who's even more importantly, who wants financing for their investment projects. I know for me, both hands really, really high. I'm always looking for financing for projects. So always very, very excited about this. So today's training is really all about multifamily commercial financing. So if that's what you are looking for, you're in the right spot. Congratulations. That's fantastic. Okay. But it is really a space that a lot of people are starting to kind of jump into as part of an investment strategy, which is fantastic. Really excited to see people starting to scale. And it is a really, really great strategy for many, many reasons. But for those that are just getting started, I want to be really, really clear. It is different than real estate, residential real estate investing. So today we're going to be talking about some of the nuances and some of the differences between residential financing and commercial financing. But again, today is all about financing. If you want to learn more about multifamily investing and the differences between that, make sure you go to our YouTube channel. We did some training a few weeks back on multifamily investing, and it's a great resource to help support you if you're looking to try to get more information about this space as well. So as I referenced earlier, tons of questions, tons about multifamily financing. Some of the questions I got: is it easier to get commercial financing than residential? Okay, that's an interesting one. I've heard that many times. Is it true that I don't actually have to qualify for the property and the property qualifies itself? Okay, so that's an interesting one too. And then there's this new program that's out there by CMHC, which is very exciting. We're going to learn more about it. 50-year amortization. Yes, 50 years. And here's the weird thing, 5% down. How do I sign up for that program? Thank you very much. I'm very intrigued. So there are lots of these questions that were coming upon me here as well. And I promise we will get all of those questions answered and so much more. But I thought I'd bring in the big guns today, okay? And to answer some of these questions. So very, very excited to have one of my personal commercial mortgage brokers, George Hilton from Montrose Mortgage, to come and join me. Super experienced guy. Lots of knowledge from Edmonton, Alberta, and his expertise when it comes to CMHC commercial financing as well, from my perspective, and it's my opinion, and I'll give him full kudos, second to none. But honestly, really, really great insight, great information. I know you guys will learn a ton from George. He is not a stranger on Savvy Investor, and he's presented on our Facebook page as well. And he's brought in some great value back then. And because of some things that have changing, the way the market's going, and multifamily is always an adaptation, he's going to be providing us with more insight of some of his wisdom to help share with us savvy investors as well, and provide more clarity to this particular topic, because everybody seems to be excited about getting into multifamily. So very excited to have him on board. So before we just get started, as a friendly reminder, if you don't mind, this is a YouTube Live. I see questions already coming out, George, so it's pretty exciting. But get that keyboard humming so I can see your questions. I'll do my best to make sure I communicate that accordingly and get those questions answered as well for you. Even if you're watching the recording, please post. I will make sure that we get those responses accordingly. To help you get the keyboard humming along, warm up that keyboard, even your mouse, even better yet. Do me a small little favor. Can you also subscribe to our YouTube channel? Give us a like, hit that notification bell if you have not done so already. One of my goals is we are on a road trip to hit 1,000 subscribers for our YouTube channel, and all your support would be greatly appreciated by liking our page and subscribing. It helps with the algorithms as well to support the growth of our channel. So thank you guys if you have already, and if you haven't, please take a moment to do that. We'd really, really appreciate that. So let's get to the topic at hand. And more importantly, let me just welcome a good buddy of mine, Mr. George Hilton, to the show. So I'll just add him in right now. Mr. George Hilton, how are you doing, sir?
Very well, thank you. I'm pleased to be here.
Great, great. Well, welcome, my friends. Great to see you again, like always. And maybe just to kind of begin with, a lot of people don't necessarily know who you are. Maybe you can give some insight and toot your own horn a little bit and just who you are, what you do, how long you've been a commercial mortgage broker for, and maybe just the areas, the geographic areas that you tend to work with, so people can get an understanding of the area, right? So,
okay.
Yeah.
Okay, thank you very much, Mike. My name is George Helton. I'm a commercial mortgage broker based here in Edmonton with Montrose Mortgage. I've been a commercial mortgage broker for 25 years. My primary focus is multifamily, both conventional and CMHC. Geographic area, pretty much anywhere in Western Canada. I've worked as far east as Winnipeg and as far west as Vancouver Island. As I go further east, I'm not familiar with the markets in Ontario and Quebec and the Maritimes, so probably best I don't try and stick my nose in there. That's sort of the background to me. As I say, 25 years in the biz, sort of been there, done that.
Awesome. Thanks for sharing that. That's great. So today we're here all about commercial financing, George, and this is everybody's interested, right? So maybe before we kind of start getting to some more of the details of some of the questions, can you give us kind of an idea what the landscape is in the commercial financing world right now? What are we seeing out there? What's happening? The activity? What's happening out there? And even more importantly, is maybe as a subsect to that, is what are we seeing investors doing when it comes to multifamily? I know there's a lot of questions, but
well, in terms of the landscape, in particular the multifamily landscape, it's basically business as usual. The market here in Central Alberta is relatively stable. We've had some ups and downs, and some sideways movement in the marketplace. We are seeing a lot of interest from outside the province coming back into Alberta. The most recent events, of course, are the events in Eastern Europe. That's very current, of course. And what that means to us is the price of energy is going up. And anytime the price of energy goes up, activity in Alberta goes up. So we don't like to benefit from other people's misfortune, but that seems to be the reality. The landscape with multifamily is pretty much business as usual. Basically trying to find the right product, trying to find a cooperative vendor that you can negotiate with, and then putting together the financing package. So not much has changed there. On the interest rate side, rates are heading up, and there has been some movement upwards since the beginning of the new year. That said, we are still dealing with historic lows. So we were very spoiled 18 months ago. We were getting 5-year money below 2%. Now it's in the range of 3%. So yes, it's been going up, but when I look at the historical landscape for interest rates, we're still at very much near rock bottom as far as rates are concerned over the last 40 to 50 years.
Oh God, yeah, 3% still really cheap money, and we tend to forget that sometimes too, right?
Yeah.
So yeah. So there's a lot of people here that are on the call. They're actually interested in Alberta. Have you seen any upswings, or what are you seeing as trends right now in the multifamily side? Or
not yet.
Not yet. Yeah.
Too early to tell. We're not like the commodities market with oil and gas and gold and whatnot. Our definition of fast in our marketplace is 6 to 9 months. So you get the bump up in the price of oil. It's going to take 3, 6, 9 months to have any major impact on what's going on in the multifamily area. Certainly the interest is there, but it takes time for it to percolate through the system.
I agree with you 100%. Yeah.
Particularly here in Edmonton, we've been sustaining some higher vacancy rates. I think the first thing that we're going to see is a decrease in the vacancy rate, and that's got to work its way through the system, get the occupancy levels up, and then after that, hopefully we'll start seeing some price increases.
Yeah, good. And I actually agree with that too. So that's interesting. So, okay. So here's the thing, we've got a lot of people that are joining us. I see. Thanks for all the comments, and there's tons of questions already popping up, but I'm gonna let George ease into it, guys. Just a smidge, right? But for those that are brand spanking new to multifamily investing or commercial investing, don't be afraid to comment and say, hey, I'm new to this as well. There's a lot of you that are here. Maybe George, maybe you can kind of give everybody just a little bit of a just a little bit of a summary of what's the difference between commercial financing versus residential financing. A lot of people are just getting into this. They don't know. And again, this is a little bit of a different mindset that they need to think a little bit differently. So maybe you can just provide some insights of the differences between the two, right?
Yeah, I think that to start off, the nomenclature is different. If you have rental units, you have a single family rental house or a duplex or a triplex or a fourplex, that's generally classified as residential. So you go to your friendly neighborhood bank or credit union, you apply for a loan based on your income. They'll take some of the rental income into your personal income, and they'll do what's called a total debt servicing calculation. So you, the borrower, are being qualified on your income, not necessarily the income or all of the income from the property that you're buying or own. When you get into multifamily, anything over 4 units is classed as multifamily, and the type of financing available is quite different than what we call residential financing.
Mm-hmm.
When you get into multifamily, there's 3 different kinds of loans. One is conventional, maximum 75% loan to value, 25-year amortization. Second type of loan is a CMHC insured loan, maximum 85% financing, maximum 40-year amortization.
Yeah.
And third type of loan is what we call interim or bridge financing, and that's where you need short-term financing to facilitate a quick purchase with a quick close, and or you want to do some renovations and then refinance later on, either with conventional or CMHC.
Yeah. Now, there's been an interesting trend actually, and I know a lot of it's been in Edmonton, but I'm sure it's not just tied in the Edmonton marketplace.
Yeah.
People buying kind of duplexes or fourplexes, but they're all single family homes. They're singly titled, but they're actually packaging commercial financing in this. So can you get commercial financing for like residential property? And then I guess what's the pros and cons in this type of structure where people are buying multiple single family, packaging it up to get commercial financing to highlight exactly what you said? It's not impacting their debt service per se, as this is being packaged as a commercial property. Pros and cons, and your thoughts on that.
Well, theoretically, it's possible. And candidly, I have not worked on a portfolio where it's a package of single-family homes. Theoretically, it's possible, but there are some practical issues that you got to be aware of. For example, if you have 10 houses that you've got in the bundle, typically at some point in time, you're going to want to sell one of them. And lenders don't like that. They don't have a partial discharge feature. They typically don't have a partial discharge feature. So as I say, I've not had any personal experience with it. I'm vaguely aware that there are some facilities out there, but it's very much a niche type of a product. It is not a generic, one size fits all product. Where you can just literally walk into a lender shop and say, hey, I need a blanket loan on 10 houses, and boom, you'll get it. Very much a boutique type of a deal.
Yeah, and I think that's something that everybody needs to understand is like, if you are looking to sell one, you got to break this mortgage. Am I correct in saying that, George? It's so the cost can be expensive, number one, and then you have to get financing separately, or again, you repackage it. And if you repackage it as a commercial, and we'll talk about costs and stuff on commercial financing in a few minutes, but the reality is you do need to be aware of it. Can you get it? And I've heard it, I've seen it, but at the same time, just want to be aware of that, right?
Yeah.
So,
and maybe I'll throw the question back at the group. If anybody has done a blanket loan on single family, I'd like to know about it, because I don't have any practical experience with it.
Good insight. So thank you. And I would imagine there's probably only a certain amount of lenders or specific lenders. Would you say that, or would most people take it, right?
I don't even know, Mike, but I would suspect it would be a very small number.
Yeah. So if that's something you're taking into account, make sure you understand the pros and cons to both sides, because they are different, right? And it's not that you can't do it, but does it really, really make sense? And it kind of really goes back to is what's the long-term strategy? And that's no different than we'll talk about in commercial financing and commercial investing as well, is there's got to be a strategy that's in place when you're acquiring, be it a multifamily property or a bunch of single families. If you're doing the commercial lending side, there's other costs and things that need to be taken into account. What's the long-term strategy when you're doing this, right? So yeah, cool. Awesome. So let's kind of get into this piece. What are some of the things when you are getting into this, into the commercial world? And like we said, it is different. I'm thinking more of the multifamily side. And there's part of it that is, there's the analysis. As investors, we know how to analyze properties well enough, and all this kind of stuff like that strategically. But what are some of the things that as a buyer, we should kind of come in prepared before we start considering any commercial financing project? Is financing kind of an important aspect that we need to take into account before we start to really make some decisions? What's your thoughts on that?
Well, to start, I coach all of my new clients to get me involved in the process as early as possible. And the reason I say that, if you're buying an individual rental house or a duplex or something, you're on your own. You make the offer and you figure out whether it makes economic sense for you. Is it a viable investment, et cetera? Then you walk into your lender and you apply for a loan and it gets approved. Because there's so many moving parts when it comes to multifamily, I do not like a client coming to me after they've negotiated everything, and then I have to rain on their parade and say,
Right.
look, I can't get you the loan amount that you need, and your timelines aren't going to be able to, we're not going to be able to meet your timelines, et cetera. So I like to be involved as early on as I can. The way I normally get started with a client is, as the client is looking at a building, they send me a copy of the listing. I run numbers, the client is running numbers, and we're comparing notes. And we can start to identify, are there any issues? Is the income where it should be? If it isn't where it should be, why is that? What do the expenses look like? Are they high, low, what have you? And then, because I'm here in Edmonton, and typically a lot of the transactions, of course, here in Edmonton, I may not know the building, but I'll certainly know the area and or the dynamics of the location that the building is in.
Yeah.
So in a nutshell, it's the analysis part that is quite different than residential. The amount of information that is required to put together a multifamily transaction is way different than a residential. By the time I fund a loan, I'm probably looking at a file that's 2 to 3 inches thick with paper, reports, financial statements, etc. So the process can be intimidating. I've been in it long enough. I'm very blasé about the level of detail because I work with it all the time. But for a new person coming into the biz, it can be a little intimidating because you're going to be looking at an avalanche of information, and the trick is to figure out what do you really have to pay attention to and what's fluff, and it's part of the normal flow of events. The other big issue with multifamily and any other kind of commercial endeavor, whether it's retail shopping mall or what have you, is the timelines. And as I said earlier, fast in our world is 30 to 60 days in putting stuff together. If we're looking at CMHC, it just takes it to a whole new level. Their turnaround time is 3 to 4 months. So if you're looking for a fast close on a purchase, CMHC is not the option. So we're probably looking at a 2-step deal, interim financing, buy the building, and then we'll refinance later on when we've got more time.
Totally. And I think we're going to talk about timelines, and George already kind of gave you a great prelude. Guys, this isn't residential financing where you get the offer accepted, you get financing, and get your conditions removed in 2 weeks. Because you know what, if you want to give George some more gray hair, do that, right? And the reality is you gotta understand the timelines that come along with this, and we'll get to that discussion in a second. So, but I think the other part that we maybe maybe you can kind of clarify a little bit more is there are a lot of different programs for commercial financing, and part of it is also understanding kind of what your investment strategy and making sure we're communicating that with our mortgage broker as well. Is it a short-term financing? And we'll talk about the differences about conventional and CMHC. But would you agree that needs to be some part of the discussion as well with yourself about what is it you're looking to do, short-term, long-term? Are you planning on flipping it, refinance, all that kind of stuff, right?
Okay. And you've hit on a good point here, Mike. The rationale when you're going, part of the rationale that we look at is how long you're going to own the building for, and that in turn dovetails into what type of financing are we going to get for you. For example, with CMHC loans, the minimum term is 5 years. The benefit to CMHC, you get a longer amortization, interest rates are lower, etc. But you also pay mortgage insurance premiums and application fees, so you are paying a fairly large upfront cost to get a lower interest rate. And when you compare that to conventional financing, it takes 3 to 5 years at the lower rate to pay for the cost of getting that rate. If you follow my drift there. The other thing, if you're looking at a value-added situation where you're buying a building that needs work, or the rents aren't where they should be, and you want to start moving rents upward. When you're submitting to CMHC, they like to see pretty. They want to see a finished product. They want to see rents at market. They want to see the building in good condition. So if you've got a value-added transaction, again, we're not going CMHC. We're either going interim or we're going conventional.
Yeah.
So that's the general thing. And these are the kinds of discussions we have very early on. I can tell fairly quickly, and I'm sure as the investor gets more experience, they'll know as well, as they're looking at a deal, where are we headed with this thing? What kind of financing do we need, and where are we headed, and what's the goal?
Yeah. And I think that's important, guys, for everybody to hear that. It's just like, you know what, you guys need to be experts in your field when it comes to this. You know, George is there to help you with the financing, or, you know, somebody like George, what's the strategy when you're getting into this? And this is very common for multifamily. Am I looking to refinance this in a year? Well, then you may not want to go with the CMHC insured mortgage. So these are things you need to get some visibility to. And I think the best way is, if you don't necessarily know, especially when you're first getting started, this is where you, like George's reference, make sure you engage your mortgage broker early, so then you guys can have that dialogue. Because as you all figure out, is there's a lot of costs that come along with the acquisition of this. And, you know, the last thing you want to be doing is incurring some more significant costs if that wasn't the right package, right program you should have been with in the very first place. Right. So, yeah. So one of the common things that we hear, and there's a few questions already on this one here, George, is, you know, a lot of people are interested into the multifamily space, especially commercial financing, is because my debt service, I'm done. I talked to Scotiabank, and Scotia's like, I'm not giving you $1 more. That's not happening, right? So you're going to have to get commercial financing. So when it comes to this, can you maybe provide some clarity? Is it mostly the property that's qualifying for the property, and how does debt service get involved, or does it get involved in the multifamily space?
Yeah, debt service is number one priority. The loan amount is predicated on the income coming out of the building. Very simply, you have gross income, less vacancy, less expenses. That gives you net operating income. And the net operating income, the NOI, is what drives value. It drives the loan amount, and it drives debt servicing. So when a lender is looking at application, they're not using your personal income to qualify the loan. They're using the net income coming out of the building to qualify the loan and to justify approval. Okay.
Yeah.
At the same time, the borrower does want to know who you, the borrower, are. They want to make sure you've got some horsepower, some net worth, and, you know, you've got the skill and expertise to be able to own and manage this kind of a building.
Yeah, for sure. So I think kind of similar to what we saw on the residential side, it is debt ratio is kind of a thing that you need to take into account, obviously, when you're buying a residential. When it comes to the multifamily space, it's not one of the main triggers. It's obviously the property itself that it's actually to perform in its own standings. And obviously the bank wants to know who they're in bed with. And that you know, that's kind of technically the answer, really. Yep. So the answer is yes. And the important part is the property's got to make sense, because that's what the bank's really investing in. And obviously they want to know who they're going to be working with as extra protection, right? So so
and I can just finish that part of it off. When you're putting a commercial property together, there's actually two pieces of security. Security number one is the building. Security number two is, if for whatever reason that building is not performing and you can't debt service because of economic conditions or whatever, they look at who you are. You know, have you got the horsepower to inject money in? God forbid something is going wrong with the building.
Yeah, exactly. Great. And here's a question from Sohal here. Does moving property from my personal name to my commercial mortgage, will that increase my debt ratio? So you're moving it, and I'm going to make an assumption here. I'm going to make an assumption that they purchased a commercial property or multifamily property, maybe under their personal name, and then moved it maybe they bought a property under their personal name, but then moved it to a commercial loan, personal name, commercial loan. Would this impact their debt ratio, increase their debt ratio? So technically, I'm going to probably say yes to that, Sohal. I believe so, because you're buying a property under your personal name. You're qualifying that property under your personal name. So they're looking at it from your from your debt ratio. But again, you got to understand, is it if a single family property or not? I guess that has to be some
Yeah,
visibility.
well,
I don't know.
it's either or. I don't think it can be both, Mike.
Yeah, maybe you're right.
If they bought a multifamily under their first name, that loan would be approved based on the income from the building.
From the building in itself. Yeah, right. Fair enough. So,
Yeah, so I think it's either or. I don't think it's both.
yeah, there you go. So also, hopefully that answered your question there. Okay, so it's some good questions that are already coming out here. And I'll get to all your guys' questions. I see a bunch of them here, but we're going to get it to get closer to the end here. So, so that's great. Awesome. That's great insight. At the end of the day, hopefully that answered your question in regards to debt ratios. I know a lot of people are getting into the commercial space just for that reason alone, but just make sure that the property is going to make sense, because that's what the bank's going to be paying really close attention to for sure. Okay. So, you alluded to this earlier about things you need to prepare for your commercial financing approved, right? And I think this is where there's some pretty big differences when it comes to the residential side. In the residential side, you got to prepare all sorts of documentation, net worth statements, and backup and all those types of things. But when it comes to the commercial side, it's kind of doubling up. Like you're kind of doing a combination of both your personal stuff and then also the property stuff. So maybe you can kind of give everybody just some Cole's notes in regards to what are these people needing to prepare, I guess, from a property perspective and maybe even from a personal side, because as George said, the file's pretty thick. I don't know if that's 2 inches, but the reality is it is thick. I've got lots of these monster files and the paperwork is astronomical. So anyway.
Okay, just going down the list, there's two different areas that we got to focus on. One is the building. We need rent rolls, operating statements. We need an appraisal, building condition report, environmental report. On the covenant side, on the borrower side, we need net worth statements. We need verification of all the assets. We need company financials if you've already got your borrowing company set up. If it's a new that's a new company, that's fine. We just need to know how you're going to have the ownership structure in place. And that's sort of, I can get into a very extensive shopping list with you, but what I do with all my clients when we're working on a transaction, I send out an overall shopping list.
Yeah.
One of the questions I get asked quite often is there such a thing as pre-approval? And the answer is no. Pre-approval does not exist in the commercial world. By definition, you folks, if you're looking at a multifamily, I'm working on the assumption that you've got some kind of net worth, else you would not be looking at a multifamily investment. Mm-hmm. So the rule of thumb is whether it's conventional or CMHC, you want a combined either an individual net worth or a combined net worth of 25% of the loan amount that you're asking for. So if you're borrowing $1 million, your net worth should be something like 25% of that, or $250,000, and that's hard net worth, equity in real estate, cash in the bank, investments, what have you.
Yeah, perfect. That's great. And George was kind enough. He's done a presentation before on Savvy Investor, and he was kind enough to put a form together, which is on our Savvy Investor Facebook page. But what I will do is I will put the link in the description for those that are interested, which will give the full shopping list of things you need to kind of prepare. So if you're getting into multifamily, you'll see it. You're like, oh my God, that's a lot of paperwork. Sit down, enjoy a glass of wine, start pulling it together, because it is a lot of work that is actually required, right? So really great. So awesome. Good insight. So let's get to kind of the topic at hand and timelines, George. It's just like, oh my gosh, right? And so, I've got Cheryl here highlighting 4 to 6 months for financing. Oh my gosh, right? And truthfully, there are some differences when it comes to these timelines, be it conventional financing and commercial, and we'll talk about that. But maybe, again, can you just reinforce or just reference again what the timelines we're looking for both the conventional financing and the commercial, CMHC, and maybe kind of the reasonings why it's taking so long. I don't know if you even got an answer to that, but anyway, I'll try that.
I'll try not to get on my soapbox too much. Okay. As far as timelines are concerned, when you're purchasing a building, a multifamily building, there's a number of deadlines that are put within the offer. Typically, the first deadline in the offer to purchase is what's called a due diligence deadline. So you make the offer, you say, hey, Mr. Vendor, I want to buy your building for $1 million. And I want to have the following, I want you to give me the following information: rent rolls, operating statements, etc., so I can look at them to make sure I'm happy with what it is I'm buying. And that deadline is open to negotiation. Typically, it's anywhere between 14 to 30 days. So you make the offer, it gets accepted. There's a due diligence period during which you get that information. And if you like what you see, you then say to the vendor, yes, I've satisfied my due diligence. Now we're into the financing phase.
Mm-hmm.
So if you are going for conventional financing, I normally recommend a 60-day window for your financing. The reason for that, it takes about 3 weeks, maybe 4 weeks to get the reports done: appraisal, building condition, and environmental. At the same time, I'm collecting all the information from you, the borrower, so that I am then in a position I can submit to a lender. So you've got 60 days for financing. The first 30 are going to get eaten up getting the reports together and getting all the info from you, the borrower. Then we submit to the lender, and lenders, depending upon what time of year it is, are going to take anywhere between 2 to 4 weeks for an approval. One thing I would highly recommend when you're making offers, take a look at the calendar and factor in any long weekends, holiday periods. Christmas is coming. And then also have a chat with your partners that you're dealing with. And is anybody going to go walkabout on me? If you're taking a trip down the lower Zambezi and you're going to be incommunicado for a couple of weeks, you got to factor that into your timeline. Okay. Yeah. And I'm not even joking when I say that. I've had files where I've been tracking people around the world, trying to get information from them. Okay. Yeah. So conventional, typically 60 days. So if you're looking for a conventional loan, 30 days for due diligence, 60 days for financing, 30 days to close. So you're looking at a 4-month timeline for conventional. Okay. If you're going CMHC on a purchase, and candidly, I have not done a CMHC purchase in about the last 2 years. Their turnaround time is 3 to 4 months. You make an offer today, 30 days for due diligence, 4 months for CMHC, another couple of weeks for the lenders, because I get CMHC approval, then I got to go to the lender and get a commitment out of the lender, and then 30 days to close. You're looking 5 to 6 months. And I don't know about your vendors, but I know the vendors here in Alberta don't like tying up their building for 5 to 6 months subject to financing.
Yeah, and I think that's a common question. I'm sure many of you guys are like, wait a minute, who in God's name is going to let me have 4 to 5 or 6 months for financing for CMHC? And it can be quite a challenging piece. Even on the conventional side, when we're looking at like 60 days, even for conventional, it's even very challenging to get that as well. So comes to kind of to my second point here is, we've got markets literally across the country, and we've got investors literally across the country. And, places like Ontario, BC, even back in Halifax and Moncton. And it's just like, there's no way sellers are going to tie up the building to that type of length. And so, in some cases, some of the strategies a lot of investors, including myself, have used is getting short-term financing to begin with, either some private lending or something of that nature. And then if I'm going to get CMHC after the fact, I just get the property locked up first and foremost, get the CMHC after the fact, but there's no pressure on the seller, and the seller's going to walk away from me on a great deal because I can't do that. So this is a question back to you, George, is private lending something that is becoming a lot more common as part of the discussions to get a property locked up, or what's your thoughts?
Well, one of the strategies I've used, and I've done it with a couple of your people that there's interim or private money if you are in a really short fuse situation. You need money and you need it now. I've been fairly successful. I've got a couple of chartered banks I deal with, and we do a 1-year term with a 25-year AM, and the rate is 3.5%, 3.75% or somewhere in that range, and it's a 1-year fixed rate. You buy the building, and when you buy a multifamily, 12 months goes by pretty darn quick.
Yes, it does.
So I've been using more bank financing. I wouldn't call it interim per se. I would just call it conventional financing with a short term. When you get into private money, you're looking at higher interest rates, but they are a heck of a lot more flexible, and they can move very, very quickly. So that's the key difference. And again, I go back to me being involved as early as possible in the process so that we can start making these decisions very early on.
Right.
The worst possible scenario is I get a phone call from a client, hey, George, we've already tied the building up, and then we've got stupid timelines which we can't meet, and then we're scrambling trying to put the, keep the deal together, and then we're forced to go private.
Yeah.
rather than having the luxury of making a conscious decision up front which direction we're going to take. I'm a keep it simple, stupid kind of guy.
Yep.
Let's do this thing in a methodical fashion so everybody's happy with the process that we're working on.
Couldn't agree with you more. And I think this is an important piece. We've talked about this a lot on Savvy is, you know what? Your team is there to help support you. You don't need to know all aspects of all things about business. When you're dealing with a mortgage broker or commercial lender, especially when it comes to this, leave that to the experts. Provide some guidelines of what you're trying to accomplish. What's the strategy with this particular property? And again, when you've got somebody like George or a good commercial mortgage broker who knows what's going on with timelines, they're there to help you, right? And help kind of steer you in the right direction to make sure that it's cost effective. We're not spinning our wheels, number two. And then thirdly, we're not overspending on things maybe we could have set up properly a little bit better at the very, very beginning, right? So yeah. Good. So let's talk about conventional and CMHC, because a lot of people are like, okay, what is conventional financing, George? What is CMHC? I don't even know what any of this stuff is. What is the difference between conventional financing and CMHC financing? Because when they hear the timelines, I'm like, okay, I got to take 4 months for commercial or CMHC financing, and then conventional is only 60 days. I'm going conventional every single way, but I think a lot of people need to understand maybe what the differences between both of those are, right?
Okay, I'll try not to take a couple hours answering.
Sure.
we could spend most of the evening talking about it. Very simply, what CMHC provides is what's called mortgage insurance, okay? And it's default insurance. So what happens is a lender's lending money. They approach CMHC for mortgage insurance, default insurance. So in the event the borrower defaults on the loan and the lender takes a loss, they can claim against the insurance. You, the borrower, get to pay for that. Now, the benefit to mortgage insurance is typically you can get a higher loan amount. Why? Because it's insured and the lender doesn't have any risk. Why? Because the loan is insured. And you get a longer amortization, and because they've got the loan insurance on there, you can expect a lower interest rate. The differential today between conventional and CMHC is approximately 0.5%. So a 5-year CMHC loan today on $1 million deal, your rate will be somewhere in the range of 3%. If you're doing a conventional loan, 5-year conventional for $1 million, your rate's going to be somewhere in the mid 3% range, 3.5, 3.7, sort of hovering in that range there. The unfortunate fact is in the mortgage industry in Canada, there is only one company that provides mortgage insurance, CMHC. So you've got a mortgage insurance company owned by the federal government, staffed by civil servants. So entrepreneurial is a word that does not come up with CMHC. And one of the big questions, or one of the big conundrums these days, is why the heck does it take 3 to 4 months for an approval? I don't know. And the simple fact of the matter is, in all the years I've been in the business, the standard turnaround time with CMHC was somewhere around 3 weeks. And if it was, near Christmas, it might take 4 weeks. And if it was in a quiet period of the marketplace, you might get a quick answer in 2 weeks. But usually it's 3 to 4 weeks. That turnaround time has been creeping up for the last 2 years.
Yeah.
And it hit 4 months, almost a year ago. Nobody, I can't get anybody to go on the record why the heck it's taking. Me, being the paranoid person I am, I seem to think that it's a deliberate effort on their side to slow down the multifamily market.
Yeah.
And that's just my humble opinion. That's not Montrose's opinion. That's just the way I read it. If it's taken that doggone long, there's a reason. You can argue staff turnover, whatever. When you go from 3 weeks to 4 months, they can't be that I got to choose my words carefully. They can't be that poorly managed that they can't figure out how to turn things around quicker. But that is the reality. So as a result, the vast majority of files I work on when I'm dealing with clients is we do interim financing, and then we refinance with CMHC later on, if that's what we want to do.
Yeah. And then loan to value rates, what are we seeing? Like if you just go to a basic conventional, and also, looking at loan to value and just even some of the amortization periods for both conventional and CMHC, what are we kind of seeing?
Well, conventional 25-year AM, as long as we can get a report that tells us there's remaining economic life in the building. The industry standard is amortization plus 5 years. You want a 25-year AM, we have to have a building condition report that tells us the building is going to be there for at least another 30 years, amortization plus 5. Same thing with CMHC, AM plus 5. You want a 40-year AM with CMHC, we need a report that tells us the building is going to still be standing 45 years down the road.
Yeah, I hope everybody just heard that, because so when you're going for your appraisals and you're looking at your building, again, George just told you a really great secret, everyone, is if you're looking for 25-year amortization through conventional, that building needs to be communicated in the appraisal, or in the inspection report that property is going to be up and standing still for 30 years. If you're looking for 40-year amortization, it needs to reference a report stating 5 years over that, so 45 years. Okay. And then what about down payments, George? What are we seeing kind of down payments for conventional and then CMHC? What is kind of typical? What are you finding?
Typically 25%. Again, it's subject to debt servicing. And again, this goes right back to the root of my relationship with the client. As we're running the numbers early on, I start coming up with estimated loan amounts, and we can tell fairly quickly what your loan amount requirement is going to be. Theoretically, conventional 25%, CMHC theoretically 15%.
Right. And here comes a question from Cheryl here is, and again, I don't know what Cheryl's property is, but how do you figure out if the town you are looking at will actually qualify for 15% down? You see the programs from CMHC, and I'm assuming it is CMHC, Cheryl, because I don't think conventional is going to get you to 15%. But the reality is, do smaller towns or specific areas not qualify for a lower down payment, George?
Yeah, I'd have to look up the exact requirement, but as long as it's, I think, a population of something like 10 or 15,000, I'll have to defer on that. But there's a minimum threshold for CMHC to go into a location. If it's a whistle stop, no. They're not going to go into a little village, where there's, the level train crossing and the post office. It's got to have some kind of economic reason for being there. Again, I don't have the exact minimum population size, but I can find that out very quickly.
Yeah. So I think the key is talk to your mortgage broker, guys. So if you guys are looking at smaller towns, there might be some slight variances. And again, it's all about risk mitigation. And so when you're looking at this and you're trying to get some of the programs, be very, very clear. But again, this is why you need somebody on your team that has an understanding with working at the banks and working with CMHC to provide you with that clarity to see exactly what, George, when I work with George, that's the one thing I like working with him is I'll give him the information. He'll put it in his fancy little calculator thingamajigger. And then at the end of the day, boom, it spits it out. For the most part, George is pretty close to being bang on, but he'll tell me, I think I could do this. I think I could do this. It's going to be probably around there. But that's where I lean on to somebody like George to help support me and give me some visibility to take those next steps. And so, Cheryl, my recommendation is working with your mortgage broker just to make sure, within whatever town that you're looking at, and ask the questions, because I would assume they'd be able to get a reasonable answer for you. Correct, George? Yeah. Perfect. Good. So here's one that, oh God, I remember George and I worked on one specifically with CMHC. And this happened I'm trying to think, it was maybe about 2 years ago, where the rules have changed with CMHC. Is like, we're looking to refinance an existing CMHC. And it's actually one of the questions here from one of our cohorts here, Jay Cabral. What is the best way to refi and pay out investors from a CMHC mortgage? So let me set this thing up. So first of all, when you go on a CMHC mortgage, I know some policies had changed a couple of years ago that if you went to refinance, you wouldn't necessarily need to pull that capital back out. You needed to either go to improvements within the property itself. And so, this was a question that I've had lots this week is, hey, I've got a CMHC mortgage and I'm just hearing that I can't necessarily use that to repay back investors. So maybe you can kind of give everybody an update of what's going on, what that is all about, and if things have changed in the policies from CMHC. So again, guys, you get a commercial mortgage, valuations maybe gone up, you've maybe got an extra $100,000 or $200,000 worth of equity, and you want to pull the equity out through a CMHC mortgage, but there may be some limitations to that. So, George, I'm not sure if anything's changed, but maybe you can just provide some clarity to that.
Yeah, that's a very good question, Mike. Thanks. There was a policy change about 12 to 18 months ago. I don't remember the exact date. The general rule requirement with an equity takeout or a refinance with CMHC is the money has to either go back into the building or be used as equity to purchase another revenue property. If what you're trying to do is refinance, take money out and put it in your pocket, no, that's not allowed under the CMHC guidelines.
Right. So what about a situation? So how do you, and this actually came from one of the questions for one of my students, because they actually asked this question is, can I use that to purchase another property? It sounds like the answer is yes.
Yes,
so what would be some of the requirements that CMHC would need to see to prove that that was actually being used to do so?
Well, this is where it gets interesting, because it depends upon which CMHC lender you talk to. If you read the strict if you take the strict the strict rules as they're written, you should have a copy of an offer to purchase, or we should be able to document the equity that's coming out of this building with the CMHC refinance is going to go to buy this building over here. So an offer to purchase, etc. Interestingly enough, I've worked on a couple of refinances where there wasn't really a requirement to provide any documentation. All we did is we said, we're refinancing and the money is going to be used. They're going to put it in the war chest and they're going to go find a building at some point in time. So they don't have a building tied up right now, but the intention is they're going to buy a building. Now that's kind of loosey-goosey. Now in those two particular cases, these were repeat clients, well-known to the lender and well-known to CMHC. I don't know if we would get away with that with a one-of transaction with a borrower that's just got one building that's CMHC insured.
Yeah. So Jay Cabral, I don't know if that's going to answer your question and put a smile on your face or a little shed a few tears, but listen to what he's kind of referenced and said. So those might be some options that you may have to take into consideration. But I think again, if
I could just do an add-on to that
sure,
answer.
Absolutely.
Full disclosure, I have not done that many CMHC refinances to get to pry money out. The vast majority of transactions I've been working on have been refinanced to pay out interim acquisition financing. So all we're doing is paying out existing debt because they just bought the building a year ago.
Right.
So I haven't seen very many pure equity cash out in your pocket kind of requests. Certainly in the last couple of 3 years.
Yeah. So it's kind of a comment here from Liz. Thank you, Liz. Based on this, they have about 2 years to purchase another property. Does that sound about accurate, George?
Sounds about right. Yeah.
Yeah. So,
but again, the goofy thing about this is they've left the wording open enough that you've got wiggle room.
Right.
And I don't like saying that, but that's the practical reality.
Yeah. Okay. Good to know. Again, guys, best thing to do, engage with your investment team, engage your mortgage broker, get some visibility and clarity to it. So you understand kind of the rules of engagement and more importantly, just some of your options. Okay. I know we're coming up to time pretty close here and there's still some questions that I've got for you guys, but I'm just giving everybody an opportunity. If you've got questions, post them in the comments. I'll make sure that I get these to George as best as I possibly can. So George, this is all the talk. And like I said, I got a ton of email on this one. I am extremely excited about this new CMHC program. And so this is the CMHC program, 95% loan to value. Anybody else likes that? I love it. 95% loan to value, 50-year amortization, nice and long. All I see is dollars, lots of dollars coming my way. My question is, how do I get this? How do I get this wonderful program? So CMHC announced this, and I'm like, yeah, let's do it.
Mike, you're setting yourself up for a fall here.
Oh, I know I am. I'm just joking around.
Fortunately, I have to rain on your parade. The announcement the CMHC came out with is strictly with regards to affordability. an affordability initiative. There's always been an affordability product available through CMHC, and the recent announcement is basically an enhancement or an improvement to an existing program. The thing that you're talking about is primarily focusing on affordability, energy efficiency, and accessibility for handicapped citizens. You've probably been seeing the press across the country about the high rents being paid in Toronto and Vancouver. This program, it's a national program, but I think bottom line is they're trying to encourage affordability projects in both Toronto and Vancouver. To achieve the high loan to value of 95% and to achieve a 50-year amortization, there's a whole checklist of requirements that you have to go through. Number one is affordability. Now, ironically, here in Edmonton, the affordability factor is actually met. To be classified as affordable, the rents being charged can't be more than 30% of the defined average income in the city. So and they publish the statistics every year. So rents below $1,665 per month are technically affordable. To be approved, not only do you have to have affordability, you have to have energy efficiency, and you have to have accessibility. To have energy efficiency, you have to establish a baseline of what your energy consumption is. You then have to go through a period of renovation, and you have to demonstrate that after 12 months, your energy consumption has dropped at least 15%. So not only do you have to have a certain number of units in your building that are, quote, affordable, and in Edmonton, basically all of them would be. So you would get, and there's a point system. You would get 30 to 50 points depending upon how affordable your rents are. Then you have to meet the energy efficiency requirement, and then you have to have the accessibility requirement. And I won't get into all the details, but things like handrails, ramps, et cetera, elevators. To hit the energy efficiency, if you're buying existing multifamily in Alberta, typically you're buying a 40 to 50 to 60-year-old wood frame walk-up, 2x4 construction. So to get those kinds of energy efficiencies, you're probably looking at new roof with new insulation. You're looking at new windows, new boiler, new hot water tank, and probably recladding the exterior of the building to put on new insulation and new cladding in order to reap the 15% energy savings. To get all of this stuff, you also have to sign a 10-year operating contract with CMHC that you will maintain the affordability component to your building. And obviously, you've already done the renovations. You have to show that you've done the renovations to get that energy efficiency. So when I look at all of the requirements that you have to jump through to get an extra 10% loan to value, you're tying your building up for 10 years. And entrepreneurs being entrepreneurs usually want to do something with the building in the first 5 to 10 years of the ownership of the building. Yeah. So the practical answer to this thing is, unless you're a nonprofit or a special interest group that's specifically trying to deliver affordable rental product to a particular segment of the market, it does not apply to you the entrepreneurial investors. So I would encourage everybody. CMHC is very good. They've got a website. They've got you can download all the requirements for the affordability. It's called the MLI Select. You can download all the requirements. And my humble opinion, it does not apply to you folks. It applies to, as I say, church groups or special interest groups that are trying to deliver that kind of product to the marketplace.
Well, you just ruined my evening, George. That's not good, right? But I'm just joking. But the reality, George and I were having a little bit of a chat about this earlier on before we jumped on. And I think the important part is, they're always read some of the policies and everything like that from CMHC. And if you go to their website, there provides some very clear information that's there based on this program. So, and again, always talk to your mortgage broker. You can provide some great insight on this one. So that's awesome. Good. So, kind of last question, George. Again, we've got people that are just getting started in multifamily. This may be even the very first video that they've actually watched when it comes to multifamily investing. What advice would you give us savvy investors that when it comes to getting started in multifamily, and specifically when it pertains to commercial financing. Would you have any advice that you can give them?
Yeah, a couple. I've already touched on it, of course, but I'll repeat myself. Number one, find somebody that you feel can provide some good advice. Your friendly neighborhood banker, if you've got a good relationship with them, or your bank or credit union or whatever, or a mortgage broker, somebody like myself. That's the first thing. The road that you're going to go down is going to be very much a consultative team effort. You are not going to be able to do these things alone. You're going to have to rely on people, and you've got to rely on people that know what the heck they're talking about. The other piece of advice I will give you, if you are first-time buyers in the multifamily, one of the biggest hurdles you're going to run into is frustration. You can take, and no offense, Mike, but you can take a course and we take the course and it sounds real easy. Bang, let's go out tomorrow and buy a building. It could take a month, it could take 6 months, it could take you a year, and you're going to look at a lot of paper and a lot of deals before you hit the right one. Now, there's always exceptions. You can always hit a home run first time at bat, but the vast majority of people I deal with, it is not uncommon. It will take usually 3, 6 to 9 months to find the right building.
Totally agree. 100%. Patience is a key, guys, in this segment as well, for sure. It's about picking the right properties, because I said there's a lot of mistakes that can be made, but it's how to mitigate that. And again, get your team involved as well. And there was a comment that was referenced earlier is, you've looked at your numbers, you've assessed it. The one thing that's great with working with your commercial mortgage broker is they're going to take a look at your numbers as well, because at the end of the day, that's what the bank's going to be paying attention to when it comes to financing. So it's a great second check for you.
Well, actually, right? there's 2 and 3 checks, and you're absolutely right, Mike. When you buy a revenue house, you're on your own. Is this a good investment or not? I don't know, and you're on your own in terms of whether it is or not. With multifamily, you look at the numbers, I look at the numbers, the lender looks at the numbers, CMHC looks at the numbers. So by the time you get through the process and you've got the loan approved, you can pretty sure the numbers are what they are. There's not, by the time you get to an approval, by the time I get to a commitment letter with a lender, you can be pretty comfortable that this deal makes sense.
Yep, agreed, 100%. That's the one thing that's great about commercial financing. So that's awesome. George, great information as always. I can't thank you enough for partaking in this.
Welcome.
Yeah, I hope you guys all got a lot of value out of this. A couple questions that I just see. Do you work with investors in Ontario? Is one of the questions. I don't believe you do, right?
I can't provide any value to anybody in Ontario.
Yeah, sorry about that, guys. But the best thing I'd recommend, if you're looking for commercial mortgage brokers in a specific city, specific province, post it on the Savvy Investor Facebook page. If you're not part of Savvy Investor Facebook, get on there and you can post it, and you'll get a lot of great referrals from there. So if people wanted to get a hold of you, George, what's the best place to reach out?
Email or phone. Email is ghilton@montrosemortgage.com.
Okay.
And phone, do you want me to give the phone number, or do you want
to? No, you know what I'll do is I'll post this in the description, guys, for everybody in the video. So then for those that are interested and wanting to learn more or to talk to George, I'll put his information in the video at the very bottom shortly after. Okay. So guys, thank you so much, George. Again, thanks again. Really appreciate it. As we kind of conclude this session as well, I want to thank everybody for joining us live for tonight's session. I hope you found a lot of great value. And again, just a small little favor from all of you that are watching live and are watching the recording, please do me a favor, hit that subscribe button to help us grow our channel. We'd really appreciate this. And it will also keep you updated of new videos, as we've got a huge schedule of a bunch of videos planned up for this coming year. And again, regardless if you're watching live or through the recording, post your questions, your comments. I'll make sure that I respond accordingly as quickly as I possibly can. So with that being said, I'm going to thank you guys all for participating tonight, and we'll see you at our next YouTube Live. Cheers.
Okay, thank you.